widely espousing and expecting an early rate cut from the Reserve Bank.
I would still say that 70% probability February, 30% probability December.
But a CNBC TV 18 poll shows that economists are still not sure that the battle over inflation has been won. None of the economists we polled expect a rate cut in the December 2nd policy. Only 10% saw a cut as early as in February, 50% saw the first rate cut in April, 20% in the second half of 2015, and 20% actually see the first rate cut in January 2016, that is 13 months from now. This is partly because most expect inflation to dip in October-November but rise again in the Jan-March quarter. Our poll indicated that economists see inflation dipping from 6.5% in September to 5.7% in October, but rising to 6.6% in January and 6.8% in March 2015. The governor's stated goal is to bring inflation to 6% by January 2016. Our poll indicated that economists see inflation decline to 6.2% at best by January 2016. Only 20% saw inflation below 6% in Jan 2016. Hence, there are no huge rate cut expectations. 70% of those polled see a maximum of 50 basis point cut by January 2016. 10% saw only a 25 basis cut by next Jan, and only 20% saw a 75 basis point cut in repo rates by January of 2016. Hello and welcome to Indianomics. Well, those were the results of our poll. Now for a more threadbare analysis of whether and when the Reserve Bank can cut interest rates, I have with me a star panel, Dr. Rangarajan, former Reserve Bank governor and clearly India's first and original inflation warrior, Sajid Chinoy, the JP Morgan economist and member of the Urjit Patel Committee on Monetary Policy Framework, and Sonal Verma, the ultimate number cruncher I know, and of course economist at Nomura India. Welcome all of you to the show. Well, obviously the most immediate factor that has enthused markets into expecting a rate cut has been this seminal fall in crude prices. It's into bear market terrain, over a 20% fall in the last 4-5 months. Let me get to the nitty-gritties. Well, with you, Sonal, first, since I call you the ultimate number cruncher. What is the impact of a 10% fall in crude prices on the CPI itself?
Well, I think we are overplaying the role of, commodity price fall on CPI inflation. WPI inflation, of course, largely being a commodity basket, gets impacted. But the impact on CPI inflation, which is largely a non-tradable basket, because it has food where we are largely self-sufficient and services, the impact is quite low. Our estimates are that every $10 fall in oil leads to a maybe about 20 basis point moderation in CPI inflation. Remember, the 10% weight of fuel and light in CPI actually has LPG and electricity, where prices are still subsidized. So it's not really crude, Lata. I think, the more important variable which we have been tracking is rural wages. And nominal rural wages on our rough estimates actually have fallen to single digits now, somewhere in the 5 to 10% range from 15-20% per annum in the last 2-3 years, and that's what's driving down the cost of production for these non-tradables. And I think that's primarily the reason why CPI inflation is coming down, not so much commodity prices.
Sajid, now to come to you. We have definitely seen the CPI numbers surprising on the downside. I remember in August we were all talking about 7.8 and finally we got closer to 7.3. Even for the month of September, I think our guesses were more towards 7% and we got a 6.46 number. So clearly, as Sonal pointed out, rural wages and food inflation have surprised on the downside. How are you assessing food inflation going forward? Do you think we have got out of that double-digit inflation for a longish bit?
I think there are several factors at play. One is you've got a seasonal drop-off in vegetable prices, but you cannot, with a degree of certainty, say that we have done everything on the ground to ensure that there's no spike in vegetable prices 3 months from now or 6 months from now. The second, to their credit, the government's been far more proactive in releasing stocks of rice and wheat, and therefore what you're seeing is cereals inflation has come off quite sharply. So the combination of cereals inflation moderating, vegetable prices coming down seasonally, global food prices which have some impact on oilseeds, pulses, sugar being benign, all of these factors have come together. But let me conclude by saying we've had 9% food inflation for the last 10 years, and one cannot with a degree of certainty say that that structural food inflation has gone away completely. What we're seeing are tactical disinflationary forces for food, but I'm not sure that we can say structurally next year food inflation will gap down from a historical average of 9% to 5 or 6%. It's too early to conclude that, and that's why I think the central bank will have to be cautious.
Okay, Dr. Rangarajan, what is your sense? You saw 4 or 5 years of inactivity in terms of offloading of FCI food and intervention in the food market. Now do you think things are picking up much better? And as Sajid said, there is this perfect storm, global food prices also falling and domestic MSP and rural wages also falling.
I think one of the structural factors which has been contributing to the upward pressure on food prices has been the MSP, except for the last 2 years. If you look at the policy decisions earlier, you have seen fairly sharp increases in MSP, and that has actually contributed to the upward pressure on cereal prices. Therefore, that is coming down now, and therefore that is in some way structural change. There are other structural changes which have been emphasized, but this also should be treated as a structural change that we are currently witnessing. Now, apparently the impact of even the deficient monsoon this year has not been as severe as it was originally thought of, and that is one of the reasons why some of the prices, even vegetable prices, have not been rising as fast as one had expected. Certainly there is no insurance against, the rise in vegetable prices 6 months from now, but my own feeling is, given the fact that MSP is not being raised sharply, given the fact that a more liberal attitude towards the release of food stocks is being contemplated, I would expect the food inflation to come down, stay at a much lower level.
Let me just get from these economists what they are expecting in terms of the inflation trajectory for March 2015 and 16. First, that question to you, Sonal. Where do you see inflation CPI March 2015 and March 2016? I know it's a tough question that far off into the future.
So I think, first of all, the underlying trend in inflation based on the numbers we've got on September suggests that the underlying trend is already between 6–6.5% on CPI. So the starting point, is just important to note because, 6% obviously is the, sort of the intermediary target for Jan 16, but we are already almost there in end of 2014. We have been positively surprised by the momentum, the momentum in disinflation in the last 2–3 months, and I think a combination of lower rural wages and lower MSPs is contributing to this decline. Fundamental factors, such as continued low MSPs into next year, output gap which will close, but will close at a slower pace. Real interest rates, clearly turning positive, more proactive government decision making. I think in this environment, and of course lower global commodity prices, in this environment, I think fundamentally inflation should be under check. While there can be volatility because of weather distortions, I think the trend should be one of low inflation. That's our fundamental view. In terms of exact numbers, I think March 2015 inflation's roughly tracking about I would say 6.5%.
Okay.
And probably slightly under 6% by early 2016.
Okay.
Of course, these are the tracking estimates, which can change. But like I said, we have been surprised positively by the pace of disinflation in the last 2 to 3 months.
Okay. Sajid, what would your numbers be?
Very similar, Lata. No doubt that inflation risks have moderated for all the reasons we spoke about. We're still looking at a number of about 6.5% or so by next March. And I think, I take the central bank at face value. I think they'll do whatever it takes to keep it to 6% the following year. I'll just make one quick point, Lata. We've spoken a lot about food inflation, but the fall in core inflation has been as dramatic. It was 8% throughout last year. The year-on-year number today is 5.8. If you look at the quarterly annualized momentum, it's below 5%. That in part is because growth impulses have been quite weak.
Yes.
So I think next year it's not fair to look at today's core momentum and project in a linear fashion, because to the extent that everyone is expecting some pickup in growth in 2015, 2016, I think that will mean that there'll be some pricing power back. So I think you should expect next year, even if food inflation remains contained, core inflation could pick back up in the second half of next year. Notwithstanding that, we're expecting 6.5 or thereabouts by March of 2015.
Well, let's take a break on that note, but thereafter we come back and ask our experts when they expect the first rate cut from the Reserve Bank.